In September, Lucky and I met with two very special professors at a crowdfunding event here at Berkeley, Professor Adair Morse and Professor Lee Fleming. Since then, their guidance and mentoring has shaped our work on this cause of creating more and more awareness here in the university and at Haas. So in short, the purpose of this event is to share what is happening in peer-to-peer space for financial services.
Adair and I, we're professors, and we're a bit on the geeky edge, and we do research and build databases. But the real excitement, I think, is what happens in events like this. And as Dean Lyons mentioned, it's a very exciting time here. And I'm over in engineering, and that's part of the Crowd Berkeley effort between engineering and then over here at Haas as well. And also the entrepreneurship group here at Haas is also working to do some Berkeley crowdfunding. So if you go to that website, you'll see a bunch of really exciting projects that Berkeley students and alums are pulling together.
My job, thanks everyone for being here. My job is just to put up a slide. That's my job, actually. So funding platforms. If we're thinking about marketplace finance, using the word broadly, there's three silos, and these silos are mushy too. But we can think about rewards, finance, Kickstarter, Indiegogo. We can think about the Kivas and the donation-based raising money for either goods or for philanthropy, right? And then we can think about the huge growth we're seeing in the loan markets, some of which is going to be represented here today, right? Just massive growth in the loan markets, and the loan markets being either, they can be for small business, they can be for just consumer loans, they can be for real estate. There's lots of different recipients, which is what is on this side. And then finally, if we think about then the equity space, and here is where, at least in my view, I don't think anyone knows, right? Where the equity space goes, how this plays out over time. We're starting to get a picture a little bit more in the lending side, but the equity side has so many unknowns. Who's going to win and who's going to lose? Are we going to, 5 years from now, have as many companies in the platform space that we have now? We're going to have more, we're going to have less. Competition surely is going to erode some of what we're seeing, and there's going to be new markets. And these are all the questions we don't know the answers to, and why we're having this panel to give a perspective on where we're going. So, when crowdfunding started, maybe the original vision was the crowd, right? And now the crowd is not even the right word, perhaps, right? Most of the money that's going into the loan platforms is from institutional investors. There's all these articles about the hedge funds investing, and then you think about, well, what's the role of the person and the crowd and the retail, and institution money looking for yield, and then just regular people wanting to look for a mutual fund of crowd offerings. Where does it go? Is it a startup or is it JP Morgan Chase? Which brings us to bringing it all together. How do we think about where the opportunities are? And these are maybe the most interesting parts are these little side notes on the side here that I've got up here. Main Street and Wall Street. How does consumption and credit and payments collapse? What does that look like when all that collapses to one? What happens when the big banks, who are already buying up a lot of the startups in this space, start buying up not the startups, but the more developed lending or equity or whatever it is, platforms, and everything becomes integrated? What does that look like? What does the competition environment look like 5 years from now, 2 years from now, 10 years from now? I don't think we know. Lots and lots and lots going on. Lots of opportunities, lots of unknowns. There's a lot of money that has flocked to the crowd markets and the lending markets looking for yield in these times when the interest rates have been zero. We haven't had a down business cycle. That's inevitable that's going to come, and we're going to figure out what's going to happen. How do we think about standardization across different platforms where credit scores have taken a whole different meaning? And when we hit this business cycle, one platform fails and one doesn't. What does that mean on how we should think about regulation, how we should think about ratings, how we should self-regulate?
What were people saying when you first started talking about equity and debt crowdfunding. And what were the experts saying at that point back in 2010 and 11 when things were really new and no one knew about it?
Crazy. That we were crazy. I'll never forget one of the early conversations. We started it out by just because we were both entrepreneurs, and we had sat at my dining room table, computer screen. One side was a blank Word document. The other side was the current 506 regulations for raising private capital that hasn't really changed in 80 years. And we just said, how would we redo this in the age of Facebook and Twitter? And we brought that framework to a couple of securities attorneys, and they let us kind of say our piece. And one of them sat back and he said, "It's clear that you are unencumbered by facts." And so, which is true. And so people just said we were crazy. And so it just took a lot of just pushing hard and a lot of conversations to try to change that opinion.
The leading indicators show that crowdfunding is set to surpass venture capital in 2016 as the means of funding startups. So there's a lot of aspiring entrepreneurs I know in the space here, Berkeley House, of course, Cal Campus. What advice would you give them in terms of if they're deciding on what funding option to choose from and when to choose, what are the different options you would advise them? Should they be looking at crowdfunding? Should they be looking at equity funding? Or should they be looking at marketplace lending as a way to raise money? And at what stage would these financing options be appropriate?
Looking at marketplace lending, it's kind of impressive when can be funded these days. 3 weeks ago, I saw a new funding platform that specialized in funding boats. And then I think there's another one specializing in financing weddings. I mean, it's pretty amazing. Anyone with an idea, with a dream can get along these days. It sounds a little bit bubbly, but at the end of the day, I think a lot of the innovation in the funding space happens back to the demand side. If there is a demand, then there is a way to fill it.
So nowadays, having alternatives available, I think, is really intriguing for budding entrepreneurs, where they don't maybe need to go for seed funding, Series A, capital raise, but potentially if they have a product idea, there are crowdfunding platforms, say Kickstarter or Indiegogo, where you could go get traction. And the other nice sort of ancillary aspect to that is you get some market validation around the product, around the idea out of the gate. Fast forward to the point earlier in terms of where that's going longer term around equity funding, right, or equity crowdfunding. At this point, hard to say. I think there's a tremendous opportunity there.
Why did marketplace lending come in place in the first place? And what is really broken with our current banking system that makes marketplace lending such a rage?
We were at an event a few months back down on the peninsula where Renault was being toasted. Renault, the founder of Lending Club, was being toasted and roasted to some extent. And one of his VCs dug out, I think, a chart from his original Series A pitch, which basically showed the spread that he saw in the marketplace. And the story goes, he opened up his credit card statement and he saw 18% interest rate. He opened up his savings account bank statement and saw 1% interest rate. So there's this huge spread. And he immediately, his mind started turning that there's got to be an opportunity there. So anyway, the VC put up this chart in this sort of his banquet setting, this big forum, and it was 2007, I guess, PowerPoint with sort of hasn't aged that well maybe, but the fact of the matter was the chart was identical to the chart that we just had last week in our earnings call. The numbers were remarkably the same. The 18% and the 1%, maybe it's changed slightly. What the Lending Club share of that in the middle for facilitating the transaction was. But to get back to Lucky's point, to have that realization, vision, and then the conviction to follow through on that particular point that he recognized as an opportunity over the last 7, 8, 9 years now, I think is remarkable, and is a real testament to fundamentally why there was an issue with the banking system and why there was an opportunity for disruption.
In the last few years with the financial crisis, credit is just not and has not been extended nearly as much as it should be for both consumers and small businesses. And that's why you see huge growth of this particular industry, because if you try to walk into your bank and get a personal loan or a small business loan, they'll ask you, just like getting a mortgage, they'll ask you for all this information and say, come back 30 days from now, we'll let you know if you're qualified or not. And now you see lots of platforms where you could go to Lending Club and Prosper and lots of other platforms out there and put in your information and let them pull your credit report and get approved within seconds or minutes.
Banks earn so much, charge so much for interest rate to individual borrowers, yet offer up so little in terms of returns for investors. I think the growth of marketplace lending and the fact that it's still been growing at such a tremendous rate speaks to the fact that both borrowers and investors are on hunger for just getting more piece of the pie, which traditionally has been occupied by banks.
We've been hearing in those conferences and publications and white papers that the total addressable market is north of $1 trillion. And we want to hear from the practitioners, what's the myth and what's the reality, and how do you guys see that?
So just to give you some rough numbers, and no one has the hard, fast numbers because we're all trying to gather the data to really see what those numbers are, but roughly it was $12 billion last year of loans that originated. They expect it to be $25 billion this year, and there's projections that it could be $250 billion in the next 5 years. The China market dwarfs what's happening here in the US. It is amazing. There's probably a couple hundred platforms here in the US. Like we have a database, for example, that has 150 platforms globally that our clients have access to, but China has 2,500 platforms. And there's dozens starting every week and dozens folding every week. But the biggest platforms, the top 10, are doing billions of dollars of these loans, which dwarfs the size of the US.
$21 trillion. That's the size of the loan market, loan and debt market in the world, I think, as of 2 years ago. Let's face it, Americans love to borrow, and the rest of the world is catching up pretty fast, especially China. Fundamentally, we're not making some projection in the vacuum saying, hey, so people are on average sharing, you have one car per 2 people in every household, and it's growing by 5% a year. Therefore, by year 2100, each person is going to have 3 cars. No, it's nothing crazy like that. People are going to borrow. The $1 trillion projection from Foundation Capital and the $1.3 trillion projection made by Goldman Sachs earlier this year came from the fact that people and businesses are going to borrow, and they will continue to choose more efficient ways of borrowing. So that's why we're all very bullish about this trend.
What are the major challenges that marketplace lending faces currently? And how are these challenges similar or different than traditional banking and what they face?
One challenge for the managers to be able to efficiently invest with scale across multiple different types of platforms.
The space is growing. It's growing very rapidly, almost exploding, if you will, in terms of volumes, in terms of number of participants, in terms of offerings and verticals and sources of capital, all this sort of thing. And at some point, at least for me, you got to take a step back and say, where does that line between kind of prudence versus grow at any cost, and where does that trade-off happen? And one of the things in terms of building up the infrastructure as a leader with Lending Club over the last 8 years, we have the ability to make those types of investments that maybe are harder to make at a smaller scale or on sort of individual cases or verticals, that sort of thing. So I think over time, and it's I forget, I think it was maybe have been Paul Tiffany, one of the professors here, who used the analogy, which is the rising tide, everybody's fine. It's only when the tide goes out you see who's not wearing a bathing suit, right? And I think there's going to be there will be challenges, right, over time with the industry relative to either economic cycles or just prudence of growth and pace of innovation, that sort of thing.
From the investor side, the biggest challenge right now is getting yield. So many investors are hungry for yield and thirsty for yield. For us, the challenge is, look, Jeremy highlighted that earlier, 150 different platforms just in the US alone. And then you have, even among the platforms, there are different asset classes. You have consumer unsecured, you have small business, you have merchant cash advance, you have boat finance, you have wedding finance. Where are you going to? Which loans are you going to select? What are you going to buy? What are you going to invest with your money? Because it may be a choice between earning a higher return and then versus losing your shorts.
We've all seen only the good times of the business cycle because crowdfunding, marketplace lending came 2010, 11, and then the investors' thirst for yield. When the cycle turns south, what happens? Are the institutional investors preparing for that, and how are they preparing for it?
One of the biggest challenges as well, that kind of goes to the last question, is liquidity. Because what people need to understand, and as a personal investor as well, is that when I buy loans off Lending Club as a personal investor, it is difficult. It's possible, because I'm in the process, I've sold loans today, but there is a secondary market for retail investors that plugs into the largest platforms where I could go in and try to sell my loans. It's not nearly as efficient as what you're typically used to seeing in capital markets and for large scale liquidity pools. You see securitizations in the space as well, and so one of the things that's happening quite a bit now with Wall Street realizing that their dollars are being eaten by these FinTech companies and this new industry, is that now there's a lot more securitizations of Lending Club bonds and Prosper bonds and SoFi bonds, and that's a form of liquidity and also a form of hedging as well. So as many of you know, you're able to short securities, you can short stocks, you can short fixed income instruments as well. And so I do think that when times go bad, whenever that might be, there's going to be additional means to be able to hedge and protect your investment. But there's still a lot more that needs to be done in order to help facilitate that challenge.
One of my favorite quotes this last week from conference about secondary market is like teenage sex. Everyone is talking about it. Nobody is doing jack shit about it. But more to the point, I think secondary market is a mechanism, and secondary market and securitization is a mechanism. And I think it is nice that if the market goes south, you have a mechanism of offloading your good stuff to someone else. But I guess one level above that is, from our perspective, we're seeing a lot of investors interested in anticipating what would happen to their portfolio in a downturn, right? So I think it is a balanced approach. You do want to have a secondary market, a properly functioning secondary market, and securitization to make sure you can facilitate risk transfer to folks who can best take the risk. But I do think robust set of systems and analytics beforehand to understand what your exposures are is going to be pretty important for investors.
Regulation is supposed to, or expected at least, ramp up in the marketplace lending space. How do regulators view crowdfunding? How do they view marketplace lending? Are they becoming more interested and active in this space? And if so, what are they doing specifically? Anything you can talk about in regulation and what's happening on Capitol Hill regarding this specific space?
From a general perspective, it's really to, yes, we need to innovate and we need to, push hard on these markets, but the different regulators are not accustomed to that business practice, and they will create problems for you. So I think just generally speaking, it's about how do you use regulation as a way to create new business models? How do you look? Because I think the marketplace lenders have been very creative in how they've attacked the current regulatory environment. I think that on balance, the regulation that's come out for retail investor crowdfunding last week or 2 weeks ago is on balance it's good. There certainly it's not all perfect. There's certainly some things that I would like to have changed if I had a magic wand. But I think that all those regulatory environments create business opportunities for how you want to construct a business, how to create a service to bridge that gap.
I think one of the misnomers or misconceptions more generally in the market, is the marketplace lending model really operates within all of the existing regulatory frameworks. All the loans are actually issued by banks. So that has all of the consumer protection laws from all the various different agencies. So, you know, the fact that this concept that it's sort of like unregulated or it's a wild, wild west, I don't think it applies directly in this particular case. Now, having said that, to Jason's point, I mean, obviously as you push innovation in terms of the business models, there may be adaptation that needs to happen correspondingly from a regulatory perspective. But certainly at this point, you know, and also to the point earlier, you know, I think one of the things that Renault has been very successful with is outreach to the regulators, outreach with the government agencies to try to figure out positive outcomes here, rather than you know, sort of taking a cowboy approach.
I'll say that the Treasury, for example, is now looking at the space very in depth, because even though there is a lot of regulation, as Chris was mentioning, there's lots more regulators out there that are very focused on it still as well. And so many of us in the industry, including Lending Club and us and others, have written responses for information back to the Treasury around the ways to look at the space to help be able to frame the discussion, to be able to help it hopefully grow in a prudent way.
Is the credit risk and managing that credit risk and underwriting. We understand that there's two different credit models, one that's used by the practitioners and another one's by the institutional investors. What goes into building a sustainable credit model that has a competitive advantage?
You know, you hear a lot of buzz in the Valley around, say, big data, and I think this is a particular area where big data is being brought to the fore here around data science and the concept of building credit models. And quite frankly, it comes down to how much data do you have, how much history do you have, what level of analytics can you do. Obviously there's the traditional, you know, credit FICO and other agencies where you can get that, you know, sort of the borrower information, but really figuring out how to piece that together in a way that is most valuable and then most sustainable and most resilient, right, in the case of downturns, is how that differentiation comes about.
Here at Manja, we also work on a different type of model in collaboration with investors. That is, it often serves as a function to check against the original underwriting.
How then do you compare the loans, the consumer loans, for example, that Lending Club is underwriting versus Prosper versus the other 20 platforms out there? And that's when you start to have significant issues around data standardization, normalization, aggregation, because, for example, the way that Lending Club, for example, not to pick on Lending Club versus another platform, they may have a different debt-to-income ratio and how they calculate that. So how do you actually do a standardization and be able to easily compare that? And the methodology of how most of these platforms, the platforms share the data and then the investors capture the data is the old-fashioned Excel file. So if you want to look at the loan tapes from these different platforms, Lending Club will say, here's my Excel file, you can download it off my website, and then the other platforms, the institutional investors and anyone, frankly, would have a hard time getting 20 different Excel files from these platforms and then figure out what the heck to do with all these files and how do you compare them in any sort of meaningful way to make sure you're doing calculations and comparisons versus the underwriting, regardless of whether you're buying actively or passively. And that's really where being able to capture that data and standardize it, normalize it, becomes imperative, and why platforms and service providers like Manja and Orchard comes into play to be able to help these institutional investors be able to do that proper analysis.
We've also seen a proliferation of crowdfunding platforms in rewards, equity, and debt. Are there other areas of the verticals where there's potential opportunity for innovation in the private capital markets that, as students, we should be looking for?
So definitely. I think that everyone's talking about platforms, and I certainly get asked a lot about people. People come and talk to me about starting a platform, whether it be on the debt or equity side or sometimes rewards. But I think there are other sectors that we're really interested in that we're also making investments in that I think offer huge opportunities. So first, platforms and secondary markets are certainly the vertical that is kind of emerged first. Next are trust and transparency tools. So the ability to, how do I, things like, if you look, what does that mean? I mean, if you look at the traditional markets, that's escrow and title and transfer are examples of that. And so, but how are we going to create these types of services for debt and equity crowdfunding? Third would be data and analytics companies. Orchard's certainly an example of that. Manja is certainly an example of that. And then fourth would be money transfer. Obviously, there's the money transfer services like TransferWire and others, but I think also this is where the blockchain will intersect with the debt and equity crowdfunding markets. And then the fifth category is the white space. All the things we're not smart enough to think of yet because the other sectors haven't emerged. I mean, if you want an analog of this, I think that looking at the online advertising market when it first began, and it was banner ads and marketplaces for selling banner ads, and then sophisticated tools to allow you to understand how those were performing, and then networks, and then on and on and on for hundreds of billions of dollars of value have been created. And so I think that there'll definitely be opportunities for creation of value in this space as well.